My name is Michael Guyette, publisher of the Lead Lagger Report. Joining me for the hour is Keith Dicker, who, by the way, is the co-host of Canada's most popular macroeconomic podcast called The Looney Hour. And we're going to get a little loony during this hour. Keith, introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Hi, Michael. Thanks for having me back today. This is pretty exciting. Has anything happened in the markets over the last couple of weeks that I missed from your perspective?
All I know is that things have been glitching. That's all I know.
Good stuff. Just to share with everyone. So first of all, we are regulated in Canada, the US. So we just have to share that everything we talk about today is not to be considered as investment advice. And just to go back to it, you used the phrase or the word loony during the introduction, Michael. And yeah, I am absolutely involved with a podcast up here in Canada. It is called the Looney Hour. And we're having a lot of fun with it and success as well. So I encourage anyone to tag along with that. And I think that sort of spills into what the conversation would be like today. Maybe that's the theme we can use, loony. And in a way that, first of all, I'll start with, we never love or hate any market. We always said we will like or dislike a market. And I think everything today, if it hasn't gone a bit loony, it's maybe a better phrase that we like to use is that, global risk has been synchronized. So I think a good conversation today, Michael, from our perspective, we run long only portfolios for our clients. They're all families and individuals. And I think what's really important for investors to realize today that there is a big difference between being an individual investor and an institutional investor. And from our thoughts and perspective, it's the industry usually treats everyone as if you are an institutional investor or a pension fund. And that's not right. Because as we are sensitive to losses. And the irony, of course, the ultimate irony is that as we get older, we accumulate more wealth. That's just a function of time and some economic success. But then the industry, they tend to tell you that you should be more conservative. And what do? They put you increasingly more into the fixed income world or these target date kind of strategies. And as we'll go through today, that's probably a pretty big mistake that has already developed, but it still hasn't played out because this global macro backdrop today, it is mostly negative, but there are some really great opportunities to preserve your capital and make money at the same time. So how was that for a beginning, Michael?
No, that's good. And actually, that is an interesting jumping off point. Yeah, there is an argument to be made that, the traditional 60-40 portfolio may have bottomed. Maybe it is going to work. The problem there is that, 60-40 is sort of your traditional asset allocation mix. That's done horribly, obviously, because of the 40, right? The bond side. We don't know if the stock side is going to have its own equivalent of what happened, the last 2 years in the bond market. So you can have a challenged period for traditional investing for a lot longer than people think.
Yeah, it absolutely is. And so we're more like long-term thinkers and what are the observations that we've made? And, I'll share this with everyone and, maybe you can do an eye roll or you'll say, you know what, that's absolutely right. But if you look at long-term rates around the world, and we'll use the US as a proxy, in the early 60s, I think the 10-year is probably around 4, 5, 6%. And then it kept going higher right up into 1982. That's when it reached its peak. And then from that point, it went all the way down to zero. So, 15, it was almost 20% up here in Canada. But long-term rates at 20% and then down to zero by the time the American housing crisis hit. So that's 30 years of continuous declining long-term rates. And what market does exceptionally well during that time frame? That anything related to fixed income. And in many ways, a lot of markets are also indirectly affected by, that pretty strong decline in long-term rates. And then, of course, we had, all the major central banks in the world, led by the Americans, they went to zero overnight rates or near zero. A couple of the European markets and Japan went negative. By the way, we refer to Europe as the economic fantasy land called Europe. So we can dive into that as well. But just continuing with this narrative with long-term rates, then we've had another full decade where in our view, we've had no price discovery or very little true price discovery in anything that's touching rates as well as credit spreads. So now we have 40 years of a period where really the bond market hasn't really had to face this moment where, hey, this is now going against us. And then to put on top of that, we're talking about the 60/40 balanced fund, mandate that's out there. Those funds and strategies, they were all created, back in the 80s and the 90s and the O's, especially those target date funds. It's all based on the continuing belief that the bond market will offset or mitigate a lot of drawdowns in the stock market when it happens. But generally, though, that the volatility and risk within the fixed income world, it's a muted one. And we think that is wrong right now. So 40 years of having, the strongest win in your sale to help you in the fixed income world, it's now gone. And it doesn't mean we're going to have a mirrored image of that going forward. But boy, as an investment manager, if you can recognize this, slow moving but dramatic turn in the rate market, it can really help you going forward. It gives us excitement because, again, we've done a pretty good job of anticipating where the market risk is. And, then you can then determine if you get an increasing risk of one market or accelerating risk or a drawdown, it's going to have another positive effect somewhere else. But that's just sort of a broader overview for the bond world. And, I know there'll always be bond bulls out there, but this market has really changed. And again, if you're a pension fund, they don't care, because you're always, one thing that people do track with pension funds, if you're not involved in that world, they have the asset side and the liability side. So with long rates going higher, from an actuarial perspective, it just reduces their liabilities. But again, as individual investors or family offices, this is something you really need to be aware of and to sort of recreate what that 60/40, should look and feel like.
So I think the traditional answer there would be, well, don't be 60/40, consider, maybe 60/20/20, right? Where the other 20 is alternatives, right? And other types of diversifiers. Do you think that we're shifting more towards a cycle where, people, advisors, allocators, they look more for, active, tactical, even passive, kind of non-traditional type of investments? Because, let's face it, alternatives have not really been a place to be for a while.
I mean, one great thing about the industry, Michael, and obviously you're involved with this side as well. As the marketplace has slowly shifted to a different paradigm, what we're in right now, there's been a lot of innovation out there, in the ETF space, especially. And, just to be, everyone be aware, we primarily use ETFs to get market exposure. So we're not stock pickers, and instead we allocate. And because we are having that innovation in product creation, it is absolutely giving managers and investors the opportunity to restructure. And, whether that 40 gets broken up down to 20 or something to that effect, we think with that's 40 for investors, that the 60/40 I'm referring to in the bond world, that you should always separate the bond world into what we would call duration, which is government bonds, and then well as credit. So that's corporate, anything related to a credit spread along the curve. And, the real interesting dynamic that's been playing out so far this year. I think everyone knows that the bond market is getting mullered out there. And by the way, when we say mullered, it's not a kind word. It means it's not doing very well. But the bad or the unpleasant experience so far in the bond world has come from duration. It was come from the 10-year going from, where were we, about 1.5% a few years ago, and now we're bumping against 5% again. That's where the losses have come from. Meanwhile, credit spreads, they creep a little bit wider, but they have not moved to express the view that, we could have a recession coming up here. And I know the data in the US is pretty strong these days, but up here in Canada, especially, and if you look at Europe and China and all those other markets, you do need a global perspective here. If we tip over into a slower growth environment, or not even a soft landing with some negative data points coming out, credit spreads have the potential to just surge higher. And then all of a sudden you have this, this fixed income nightmare that was just led by duration, giving you a lot of grief. Now credit spreads are widening out at the same time. which of course then are going to affect, earnings, profit margins, and so forth. So this is pretty well a really neat setup if you're able to envision it. And then, you're able to then anticipate which products and tools to use to get exposure to benefit from it, or, to move or step outside of the way.
Yeah, I think people have a hard time understanding that you can be bullish and bearish on bonds at the same time. It's a function of whether, to your point, it's duration or credit, right? I mean, like I myself am bond bearish, which sounds weird, right? I'm bond bearish because that's what a credit event is, right? It's the spread widening that causes junk in particular to really break down, the equity proxy within the bond market. That's not to say that at the same time, treasuries, or government paper for a moment in time couldn't do well during that, which is the flight to safety dynamic. I haven't talked about this with others, but I'm curious, since you mentioned credit spreads, are they as correlated to credit spreads in the US in Canada? Meaning, it sounds like they're also very tight now, but is it abnormally tight even relative to Canadian companies?
Yeah, so the corporate bond market is extremely small in Canada, and it's not really a proxy that one should use, for gauging the health of the fixed income world. So instead, you always have to, look south of the border, as we would call it, into the U.S. market, which is incredibly deep, of course, with lots of liquidity. The Canadian corporate debt market, I think there's not a lot of issuers. When there is a new issuance, it's gobbled up almost immediately by the pension funds and a couple of the mutual funds and so forth. So there's not a real big liquid market in it, but that's what should, scare the crap out of you if you're an investor. If you're in a corporate bond strategy that has, very little to no liquidity, and then all of a sudden you do have a liquidity event, how do you mark it? It's one of these things where, everyone's trying to run, towards the end of at the door, at the end of the gym to get out at the same time. And it's incredibly difficult to get there. And that's the irony with the fixed income space outside of the treasury world, is that, you're there because you want minimal volatility. You don't want to protect yourself against some events, and scoop up your coupon all the time. But the moment you want one of the most important investment attributes, which is liquidity, the moment you need that, it disappears in a lot of markets. And again, that's something else that, people have to be aware of.
Since we're on the topic of Canada, it sounds to me like your banks might be as fucked as our bank in the US. Just talk about maybe just the state of the financial system and the way banks have behaved in Canada, because it does seem like in the US at least, people are aware of what's going on, but maybe not as aware as they should be.
Yeah, it's a really great conversation, and I would imagine most people listening here now are probably US based. But again, as an investor, it's really important to have a global perspective of what's happening, literally around the world. So I worked offshore for over a decade with a private bank. And one great thing about living on a small island for a long time is that you have no home country bias. So you don't see the world through where you're living. So as a Canadian, we tend to view the world as Canadians. We would then, project our morals, ethics, and values onto the rest of the world and believe that's the way the world should react. The Australians would do the same with the Brits and the Germans and so forth. But when you are in this sort of a jurisdiction that does not exist, you tend to see the world differently. So it's just sort of setting the stage here to talk about the Canadian banking sector. And then the other thing, think about, for everyone who's not aware of Canada, the Canadian economy and the banking sector, it's very similar to what we have over in Australia, and the same as well with almost any of the European-based countries. It's heavily dominated by a very small number of banks and institutions. So, I mentioned before, we never love or hate any market, but there are times to like and dislike. But let me just give you the setup here now for Canada. And again, it goes back to what has been your experience in markets? And based on the length of that experience, people are linear in thinking. I think that's where a lot of people sort of get tripped up. So going back to that narrative we started with, Michael, with long-term rates, going higher in the 60s and the 70s, and then, 82 hitting the high, coming down low again. Over the last 40 plus years in Canada, we've never had a true national recession. We've never had a crisis within or across our banking sector. And, for that reason, Canadians and the culture for investing, and it's built up through the media as well. It has everyone strongly believing or convinced that the Canadian banking system is invincible and that nothing can ever harm it. Because if you go back for 40 years, stock prices always go up, dividends always go up, and book value and return on equity, and you name it. As a proper investment manager, you should always look at risk first and not return. Because you're always doing return. It's, you're shooting for a return. You always attribute high returns to a skill set, because everyone's awesome at picking stocks. And when there's a big drawdown in the marketplace, the reaction is usually, no one saw it coming. Don't worry about it. You'll hang in there. Instead, if you take more of a risk perspective and you're able to identify markets or industries or sectors that have a high probability of experiencing a sharp drawdown, then you can properly manage your positions. And you still take exposures, but you really need to control your exposures. And that's what will generate, a consistently producing, positive return experience over the long run. So with the Canadian banks, one thing that we look at now is that because we have this sense of invincibility across the Canadian banking sector, there's a lot of complacency in believing that, that sector can never experience a crisis of any kind. But the potential that we have now is that we have two things hitting at the same time. One is that, the Canadian housing market, most people are probably aware, depending on which metric you look at, if you laid out maybe 10 metrics for the housing market in Canada, maybe 8.5 of them are going to tell you, wow, this is a bit frothy, very expensive. It just cannot be maintained at this pace. And then when you look at the global economy at the same time, you realize and appreciate that if in Canada we have a recession. So yesterday, the Bank of Canada came out, on Wednesday actually, Bank of Canada came out, and they're predicting maybe we have a very slow to near 0% growth year next year, but not a recession. If we get a recession in Canada, it's going to create this experience for banks for where all of a sudden they have the increased or loan loss provisioning has to happen. They've already started doing layoffs. Some of the banks up here, they're already announced they're trying to sell off certain loan portfolios and so forth. But a recession in Canada, it was going to affect households, and all of a sudden you have less discretionary money available to allocate for spending because you have to, use it to pay off any debt that you have due on a monthly basis. But at the same time, though, banks start retrenching. And when banks retrench, they do less credit creation because it is the banking sector that gives the economy, the air it needs to grow and breathe. And I'm just concerned right now in Canada, we are potentially going into this environment. And the banks are telling us this, if you see the announcements they're doing, that they're equally concerned. So right now, if there is no recession in Canada, over the next 12 to 15 months, and, maybe it'll be okay. But then we're still exposed to what's happening on a global basis with either the Europeans, China is really struggling. The Americans, I know that economy can certainly slow down dramatically. But the point is that if we do get any kind of a negative event in the economy of financial markets, it could really hit the Canadian market hard. And if you know that, then there are ways to play and actually make money off it.
How intertwined or interconnected are Canadian banks to U.S. banks? Trying to see if there's a risk of contagion. I think most people, when they think about a financial crisis, think about the U.S. infecting the world. Could Canada infect the U.S.?
No, I'd be surprised with that. Again, almost all the banks have U.S. exposures, but let's just say Canada has a crisis on its own in the banking sector. It will impact some of these U.S. investments that these Canadian banks, I'm not going to name specific names with the conversation today, but it is going to impact, again, like credit creation in certain regions where their investments are taking place. But it will not impact the American economy on its own. This will be a Canadian specific event. However, the opportunity is there is that if all of a sudden Canada does, it is the economy to ignite or, re-escalate stress in the financial marketplace, so then it could probably then spread to somewhere like Australia, maybe Europe. And the way it's spread, you don't need to have a direct investment with another market to create contagion. All you need is for an investor to say, you know what, that's happening over there. I think could happen here as well. I'm taking my money out of the market and I'm going to park it in the market that's the biggest, deepest, and liquid enough, to preserve my capital until this plays out, which of course is the US dollar. So, that's the sort of view on that part, Michael.
Let's get some of the audience.
Yeah, those are some really good observations. And, there's no easy answer or solution for this in Canada. Because you have to look at it from the regulator perspective and then the Bank of Canada, and then as well as what's happening on the fiscal side. And the fiscal side is, as you know, it is quite messed up. Like every government around the world, the Canadian government is running a pretty large and unsustainable deficit. And at the same time, and a lot of this was driven by the COVID pandemic policy responses out of government for spending. And now, because of the way they structured that debt, a lot of that is coming due now in 24 and even 25. So Ottawa has rate exposure on this. To cover that, they have to issue more debt. If the current government is still in power, which I doubt they will be, by the way, by the time 25 rolls around, they will raise taxes, and that contracts the economy. And then, of course, that's going to hurt banks and their ability, to grow and to generate more earnings that will hit their balance sheet in the best way possible. So at the same time, as you say, the regulators, they're trying to figure out how can we protect the banks if the economy does roll over. We have these, global macro headwinds hitting them. And I just think that the real risk we have is that regulators haven't experienced this situation before in Canada. And my experience from chatting with everyone in this space is that it's always the assumption that it's just a normal cycle, and they never consider the impact that it's not a normal cycle. And we get to use the word fat tail event there now. It is in the title. But maybe, if a fat tail event does occur, I think it's going to be really difficult up here. And I think the Bank of Canada, they've already set the stage with their response to what happened back in 2020. If the Canadian government bond market or anything underneath it, like the provinces or, the corporate sector, if they do run into problems, the Bank of Canada will absolutely run in and they will support that market. So I think that will support pricing for the bank's regulatory capital. But of course, then, risk has to get expressed somewhere. And in our mind, it gets expressed in the Canadian dollar or the loonie, as we call it up here. And I just think it's not a great opportunity on the long side. With cross trades, I think you really need to break it down between a normal cyclical downturn and then something different. And something different is where we get a coordinated, global risk event. It happens and it accelerates really quickly. In that kind of a market, I think it's going to be difficult to differentiate which cross rate is going to do better than another. So I just think it's one giant rush into the dollar. And that's, after it gets cleaned up, like in that kind of event, I can see Canadian dollar going out like with a little 5 handle in front of it. I see euro going low 90s and things like that. But then again, that's just some kind of a crisis event developing. And maybe it doesn't happen, but, conditions right now, no matter which way you're looking at conditions, so whether it's financial market or geopolitical, it is set up to potentially create something that may not be pleasant. In a normal cyclical downturn, I would suspect that Canadian dollar will outperform euro. And mostly you're going with the energy perspective, because we are protected with that to a certain degree. Now, whether it actually works out from any economic data point or not, I think that could really be argued. But again, with currencies, it's always, once you get past the, comparing the yield curve and rate differentials, it comes down to, what is the expectation or the reputation of a country over another. And I think a lot of people view Canadian market, it does have a pretty strong production from the energy sector, and that would dominate over Europe. I think Europe is really set up to have a real hard time going forward. And if for some reason, energy prices around the world, they do start to really escalate higher based on conflict over the Middle East, I don't know how Europe gets through it. That they're really struggling. The problem with the euro currency, of course, is that, they have one monetary policy for 19 countries, but there's no common debt issuance for the 19 countries. Each country is still, running their own bond book in issuance. So it creates this experience of, hey, you're a euro. Where do you, if you want to buy a euro bond, what do you buy? Most people would immediately say, you're going to buy the German issuance, but the German economy is coming down pretty hard these days. So again, I don't think Europe is a market. Well, I know for us, it's not a market we're focused on. The focus we have on with Europe is to avoid it, and then just to appreciate if Europe does have a re-escalation of stress from any kind of event, how that's going to impact other markets. And the immediate impact is that it is going to drive the dollar higher, which is then going to affect the Canadian dollar as well.
Let me reset the room for the meeting. And everybody, please make sure you follow Keith here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcasts under Lead Lag Live. I'm going to assume all this talk around the euro then goes back to the fantasy land comments you made earlier. I think everything's in fantasy land at this point. But is there any hope for, listen, every allocator ultimately has to make a decision to invest based on whether price is overreacting or underreacting to all available information, right? It's ultimately about overreaction versus underreaction. Do you get a sense that, at least when it comes to looking at Europe, despite these kind of concerns around it as a basket case, you can argue from a fiscal monetary standpoint that it's undervalued, that there actually could be some kind of, potential for alpha there, or are we just not there?
In Europe?
Yes, I guess that's my answer.
I guess I'll answer your question with another question. Europe? Here's another funny narrative for everyone to think about. I'll go to the CFA Institute. I think a lot of us have gone through that program and everything. And, we're all taught about valuation metrics to look at and the CAPM and all these, great models and stuff like that. We don't put a lot of belief in valuation as a tool to determine, an entry or exit point into equity markets or any financial market. It's simply a function of if there are more buyers or sellers in the market, and that's going to drive something higher or lower. And that's how a market will move. And so when we look at equity markets, we put a pretty significant weighting on models that are just focused on trend and momentum, for example. And just using that as a blunt tool, it's able to suggest to us when we should be more aggressive or, more conservative or defensive for equity markets all the time. And so we rarely get into this moment where what hasn't happened now with this cycle, Michael. And what I mean by that is in a period where the global economy is tightening, things are getting a bit more uncomfortable. Capital flows, so that they go back into the US. And then when the opposite is happening, they leave. So if we're in a global environment where the world is deemed to be, okay, yeah, we're going to start growing again. It's great. So the EM world, the emerging market world will do extremely well. Europe has always been deemed to be offer great leverage to the emerging market world, and that would happen. It's our view today that the opposite is happening. So people forget that, before the pandemic started in 2020, at the end of 2019, the world was already grinding tighter. The global growth was slowing. Every major central bank was getting dovish and so forth. We were already tipping over into something that wasn't going to be very comfortable. And, then of course, everything got distorted with the policy responses, from the pandemic. And then, it created this massive euphoria in 21 that really was euphoria just based on central bank liquidity just gushing into the economy. But now all of that has been rewound, or it's slowing dramatically. Now we're back to this sort of 2019 period again. And that is not a positive environment, for the financing land over in Europe. The other thing to think about as well, we spend a lot of time monitoring and following central banks, and sometimes I'll refer to us as being a central bank groupie. If you think about being cool or something. But with central banks, so the world's always focused on the Fed, and we have to, but the Fed is a different central bank than the Bank of Canada, than the ECB, and everyone else. And I know people, they say, oh yeah, it's the world's reserve currency, but sometimes I'm not sure people really appreciate what that means and how that makes the US different. And so for that, you have to go back to really the 2018. So remember that period, guys? That's when the Fed, I think they were hiking rates by 25 points every second or third meeting. It was kind of painful where they were going, but they did it.
But by the way, it was also only that Christmas Eve massacre, and the seasonality was thrown out the window.
Yeah. So I remember I wrote a note back then, I sort of pictured this scene where, the Fed are there, the one phone ring is the Chinese to say, hey man, you got to stop raising rates. You're killing us over here. And then the other phone rings is the Japanese saying the same thing. And then the ECB is on another phone, and the Canadians and the Aussies and you name it. So right now, you think about this, that the Fed has every reason in the world not to be dovish. Again, like the data points they're pretty good for the US. We saw some of the data points this morning. They weren't dovish, not at all. Meanwhile, the Canadian data is getting weaker. Europe is getting weaker, despite what the ECB was trying to sell, yesterday. And so as long as the US is in this moment from a monetary perspective, where they absolutely have the data to support them to stay hawkish, and they want to, I suspect they're going to remain hawkish until something really does break. But the challenge for markets is trying to appreciate what breaks. Is this something in the US? Does California turn off all the lights when the last one leaves? I would suspect that the area or the marketplace that does break, it's going to come from outside of the US. So again, if you're not keeping your eye on other markets, you may miss it when it happens. But again, you could have something breaking, whether it's in Europe or Canada or China is really one of the key markets. I think it's very vulnerable right now. I mean, if they did a devaluation this weekend, the dollar is just going to go vertical on Monday morning or Sunday night if you're living in the futures world. But again, that's just some other thoughts for everyone.
I feel like that's a good transition to talk about gold, because I do myself believe that speaking about fat tails, there could be a positive fat tail that could happen to gold. I was on the way to the city yesterday, and I randomly just said to myself and posted based on my own thoughts, I think you could have gold go vertical and suddenly make new all-time highs as early as November. And I say that largely because, gold does act as a relative safe haven. It is among the kind of risk-off proxies, and probably better than Europe as an investment potential story to go into. What are your thoughts on gold? And importantly, if you're going to be allocating to gold, how do you think about weighting it?
Yeah, as a good Canadian, I think every Canadian house has a piece of gold and a hockey stick somewhere lying around. So it's sort of in our nature. With gold, though, it's, we hold gold. We do have an allocation to it for across our client space, so across the portfolios. And our view with gold has always been that it's something you hold, to protect you from kind of systemic risk event, whatever it may be. We've never viewed it as a way to protect yourself against inflation or something like that, or people say money printing and all that stuff. That's not the reason to hold gold. Again, you want to hold it, protect you in case it really does hit the fan out there. And in some ways, so for our portfolios, for non-USD based portfolios, we're having more success for protection and exposures to our currency strategy than holding gold. Because if you're holding gold, if you're not a US dollar based client or investor, I should say, and you're holding gold, then you're getting two experiences with this, or you're getting the currency as well, the movement in the price of bullion. So for us, we're taking protection and exposures to a currency strategy, which really will benefit when the dollar is appreciating rapidly against euro, CAD, Aussie, pound, and all those. So again, we like gold, as I mentioned earlier. At this point, there is the opportunity that it could do extremely well, so we have exposure to it, but it is not at this point our preferred exposure to provide protection against one of these fat tail events.
What are some of the, just based on the work that you do, what are some of the fat tail risks, extremes that could happen that maybe are not being talked about that, could be sleepers, would be more of a gray swan to you, but maybe a black swan to others?
Yeah, I think, you can always rank them, and, it doesn't matter which one happens because they'll probably have the same and equal effect around the world. More of a broad-based perspective would be a credit event. And so a credit event in the non-sovereign debt world, that could escalate rapidly, and that creates contagion. So that is a fat tail event because, again, credit spreads haven't moved. No one is really positioned for, because the debt world by nature, it provides leverage to the system. If we had an event in that world, it's going to create some unpleasant experiences. To be more specific, Michael, it would really then come down to China or Japan. The challenge with each of them right now, it's really in the currency space. So China has a closed capital account. So they are pegging their currencies, it's to this sort of mystery basket, which of course is heavily dominated in USD. But because they have a closed capital account, it's hard to get your money out of China. And when it does, so just say you're sitting in China and, you accumulated, say, 10 million USD, whichever way you've done it, and you decided, I've had enough and I'm leaving. So when you're on your way out the door, you're selling your yuan, they give you US dollars, and, then you go. And for you to get your US dollars, you're getting it from your bank, which is getting it, from the central bank. So that's where it comes from, the FX reserves for China. So they are always transacting within their FX reserves to provide capital outflows from the country to maintain their currency peg. And if the stress on that is significant enough where they're not able to hold, the magical rate right now, what are we around? 731, I think, right now at yuan, in that range. And it's been up in that range for a while. But something like that, it would create a pretty significant wave across Asia. If you jump over to Japan, they have it open. They do not have a closed capital account. Anyone can put their money in and out. If you're a foreigner right now, you're saying, why the heck I put my money in Japan? And you're looking at their market. But they have to make, when I say they, the Bank of Japan I'm referring to, they're making some pretty loud statements and decisions right now. They have to choose between either saving their bond market or the yen. They can't do both. And on the face of it, the simple answer is they have to save their bond market. Because if they let their yields spike higher, you get price discovery in their bond market, in the JGBs, then, all of a sudden you're going to create significant losses across the banking system, regulatory capital that will really get hit with it on paper. Pension funds get hit. It just creates this extremely unpleasant scenario where the government then has to issue even more debt. They have to pay more for it. So with the yen continuing to leak lower, if we do get an event out of Japan with the yen, say it comes down 5% in one day or something, then that creates stress on China as well. So it's all sort of floating around. And it just means that, from an investor perspective, keep your eye on all these ducks out there and make sure you have an allocation in your portfolios that will protect you, in case some of these things happen. Now, it doesn't mean they have to happen, but it just means that the probability of it happening, in our view, is higher today than it's been for a while. So, and again, we don't live in absolutes. We just live in a world where, probabilities are changing dramatically.
Keith, for those who want to track more of your thoughts, more of your work, where would you point them to?
Yeah, you just come up to Canada and you can ask for Keith. They'll show you where I am.
I'll work on that.
We need a sense of humor. I know.
My entire timeline is humor. There's people who think I'm serious with all my insane posts that have I don't know, they need to get their head checked. But that's a whole different thing.
So for people to find IceCap, you can find us on our website, icecapassetmanagement.com, or you can connect me with you on Twitter at IceCap Global. Michael, this has been fantastic. I had a great conversation here, and I'm looking forward to doing it again at some point soon, maybe.
Yeah, I'll have a podcast in a couple of days, folks. Thank you. Appreciate it.